Welcome to Subramani. If you are in the markets, especially if you are in the equity markets as an individual and you are coming into direct equity, not into mutual funds, chances are you will be scared, right? The most important thing to do during bad market times is to either buy more or to sit tight, right? The ability to sit tight is not easy because March 2020 you would have seen that the world was going to end with COVID. And there was selling. So if you bought more in March 2020, by September you would have been proved right, and if you didn't do anything, even then by September you would have found that your portfolio came back to where it was pre-COVID. Now similar things are happening, and look at the headlines which we are seeing, right? I don't want to name the newspaper, you can go and look for it. The stock market crashed today. The BSE Sensex ends over 1400 points down. Nifty 50 below 22,150, and top 5 reasons for the bloodbath on D Street. Now 1400 points looks very big, but understand that your index is something at 85,000 or 75,000, then a 1400 point fall means almost nothing. It is a 2% fall, and that's very regular. Very regular to see 10 and 20% falls. 30% fall may be not so regular, and the 50% fall will definitely happen once at least in your lifetime. It has happened in my lifetime. I think that was 1994, 93 or 94, I think 93. So these things will happen in our lives. So, but look at the fact that even if you had not panicked, you would have seen such headlines and said State Bank of India, State Bank of India, Tata Motors, HDFC or TCS all hit all-time lows and 52-week lows, and is this the time for you to consolidate or is it the time for you to sell, right? So these kind of headlines saying 40 lakh crore wiped out in a 4,000 point fall, even for people who did not panic, these headlines will send you into a panic. So beware of such headlines. There are various reasons why the market falls, right? So here this is a great newspaper. Not everybody says nice things about them. So they say that while BSE Sensex went down 73,000, went below 73,200, Nifty was below 22,150. And BSE Sensex ended the day at 73,198, a 1400 point fall or a 1.90% fall. A 1.90% fall. Imagine the headline saying a 1.90% fall. It will have no sensational impact like a 1400 point fall. 1400 point fall from 2800 index is very different from a 1400 point fall from a 78,000 index, right? So maybe the Nifty was also down, and then a sharp fall occurred amidst widespread selling before crucial GDP data came, blah blah blah. Nifty IT index also experienced substantial losses following downtrend in Wall Street. And the Nifty Auto Index had a 4% decline, while all other sectors like Bank Nifty, etc., also showed decreases from 0.7% to 3.5%. So, why did the market fall? None of us know why the market fell, right? So, obviously, you will have to find some causa proxima, right? So the nearest causes to why what happened, right? So it's like saying, oh, yesterday he had too much of food and therefore he got a heart attack, kind of a thing. It didn't get built up in one night, right? It got built up over a long period of time. So similarly, so first they are saying is apprehension of GDP data, economic growth concerns, declining earnings momentum. Let's look at it this way. Either you grow at 6.5% or 6.2% or 5.9%. It's not too bad at all. Over 30, 40, 50 years, see how the people around you have improved their standard of living. So I don't think that is something to worry about. But yes, this is the great newspaper saying what is the reason. Trade policy uncertainty. Trump's recent announcement shifted the implementation of 25% duty on Canada and Mexico, right? So to March 4th, advancing from 2nd April timeline. So that is the reason. Why should India fall? Because Canada and Mexico will have tariffs. Beats me. IT sector faces downturn. Honestly, I don't see any great downturn in IT immediately. I'm not even saying that it's a great buy or not a great buy. I have no clear sector specific views to be given, at least not on this podcast, right? Asian markets experienced a decline on Friday with MSCI Asia ex Japan dropping 1.21%, right? The strengthening of the dollar, because the dollar strengthens, more people will shift money from India to US, and continuous foreign exchange outflow. The white man is selling, or the FII is selling. Well, there can be various reasons why the market is not doing well, and let's say over the past 6 months, the Indian equity market has definitely experienced volatility. The Sensex hit an all-time high of 85,978 on September 27, 2024. But by late January, it had fallen by 10,000 points, which is about 12%, right? 11.79%, reaching about 75,978. In February, it has fallen further to reach something like 75,295, and maybe 74,000 and odd is what it would have ended now, right? Which means it's a 10% fall from the peak, and that is not too bad, but that means it is just a fall. It is still not bear market. Bear market definition happens at 20%. So if there is a 20% fall, so which means another 10,000 points fall, then you could call yourself being in the bear market. So what are the reasons? Let us look at some more reasons. So first is, of course, one very simple thing: demand and supply. If the demand for your shares are more than the supply, prices will go up. If the selling is more, then the prices will go down. So there has definitely been FII selling. FII wants maybe more money to be invested in the US, maybe other emerging markets were cheaper, more attractive, so they sold. So don't get any emotional and saying, oh, the FIIs are selling, they don't like India, they like profits. So they'll happily take profits in one place and invest in another market which is not so overpriced, right? Many Indian companies, if you see, when they produce when they produce the quarterly results and they give you an indication of what is going to happen in the future, they are not very optimistic because the market prices are already high. Our expectations are we will get 25% return in equity year on year. We are not going to get. So if you have 2 years of 25%, it will be followed by a -4 or a -8%. So if you say any shares, even when you see an HUL or Tata Motors or TCS or some of the top companies, you will find that if it has grown too fast, it will pause for taking breath. That is what is happening. Indian markets have to take breath. It cannot run without any oxygen. So it is maybe just holding on to take some oxygen. There has been global factors that more and more people are interested in investing in the US. So so some money will get withdrawn from all emerging markets, and therefore your currencies will take a hit, and these things are bound to happen, right? Am I worried about? What am I worried about? I'm not really worried about too much, but I'm saying high valuations, weakening rupee, sell-off by the FII, and some sector-specific overvaluations which one can see. All these are, I mean, perfect recipe for a fall, right? So it's not to say it can't fall further. It can fall further. So what should you do now? That's a more important question. First of all, go and assess your risk tolerance, and when do you need money? Do you need money after 3 months, 6 months, 8 months, 1 year? Then just hold on. The market will recover. I do not know whether the market will recover in 2025 by, if I say 2025, people will say June or November or December, right? So I don't really know, but somewhere it will recover. Maybe in 2026 it will require. If you don't require money for the next 2, 3, 4 years, 5 years, there is absolutely no reason for you to worry about, and this is not perhaps a time to be withdrawing money from your equity fund. If you need money, your go-to place now is debt. 6 months back, September, maybe if somebody had asked me that, look, I want 5 lakhs, I may have withdrawn from a flexi cap fund. But today, if they want money, I would rather remove from a debt fund rather than an equity fund. I've always held that when you invest forever, right? So my view in the market is forever. So I take 20-year views of the market. I don't need money for the next 20 years, or at least I don't think I need money for the next 20 years. Or whatever money I need for the next 20 years, including my daughter's wedding or education, I can sell off whenever I need on that particular date, rather than worry about the withdrawing in advance, because I have my investments in different asset classes, and some of the asset classes like debt and gold are not as violently fluctuating as equity. So of course with gold I may have to be a little more careful, but yeah, maybe gold and silver or something which else I can sell, or debt from which to fund this rather than from equity, right? You should definitely have a diversified portfolio, which means you should have equity, you should have debt, you should have large cap, mid cap, small cap. Though I'm not a person who likes to break the market into large cap and mid cap, I'm more a industry guy. Is automobile good, is pharma good, or things like that, rather than, or is equity market good over a 20-year basis, rather than looking at will large cap do well or will mid cap do well. To me it makes no sense. Though there are some people who say it is a time to get out of mid cap and small cap, and there is one person, the diametrically opposite view, who is coming out with an NFO for his mid cap fund right now, right? So diversify, don't panic, right? Monitor some key triggers, saying okay, if the US grows, then this is what will happen. If India buys more oil from US, then we will not have a trade deficit with or imbalance with the US, right? So look at all that. My simple advice is, if you have enough money and you don't need the money in the next 5-7 years, there is no reason for you to panic. Continue your SIPs, continue buying individual stocks if that is what suits you, right? Make sure that you don't leverage, don't do F&O, don't buy with borrowed money. All that can hurt you. If your job is a little uncertain, then you have to be in more conservative assets than maybe a younger person, husband and wife both working in high-flying jobs. They have to be perhaps less worried. But if you are 50 and you are in the IT sector, chances are if you lose your job, then what happens? Then you should re-look at your portfolio. Thank you.